Hi, I'm Chris Gessel, Executive Editor of Investors Business Daily. Thank you for purchasing the IBD Short Selling Home Study Program. For quite a while, our subscribers have asked us to produce a short selling product to help them take advantage of bear markets. After much research and analysis, we have developed this home study product to provide you with key insights on how to sell short successfully. Short selling is not easy, but if you learn to do it correctly, it can be quite profitable. We have put together a comprehensive program that focuses on the two major chart patterns that occur with short-selling candidates. The chart examples were hand-selected by IBD founder and chairman William O'Neill, who also personally created the notes that appear on the charts. The examples span decades to show you how these chart patterns happen in every market cycle. So once you learn how to short the right way, it will be a skill you can use over and over again. This home study program includes a workbook with shorting strategies and insights, an oversized chart book with dozens of examples, and this DVD, which provides 11 chart examples narrated by Bill O'Neill. Remember, there are tremendous opportunities during a bear market. If you stay engaged with your IBD subscriptions and the resources on investors.com, plus use what you learn in this home study program, you'll be in a position to profit. So let's get started.
We're going to talk about short selling. Even though we're going to go through short selling, this is a little more difficult than actually buying stocks. So don't think this is going to be a holy grail that you're going to figure out an easy way to make money. But you want to know this skill, and we'll go through in a lot of detail. There's a long list of items that are kind of critical, so we're going to go through each one of these and discuss what are the key things you need to know about selling short. So the first thing is I don't believe in shorting during a bull market. Now, if you think you're in a bear market, that's the time to be shorting. Now, why would I say that? Well, in a bull market, you've got a lot of Apples and Googles and Baidus around, and so what do you want to be wasting your time trying to sell short at various intervals? Confine it to once you think you're clearly in a declining market. Now, there's another reason, too. The proper time to short is not trying to short when something is going up and moving rapidly and you think it's too high or the PE is too high, because you could get taken to the cleaners. You could just keep on going up. So you've got to wait until it's clear that this stock is in trouble, it has a bad break, and then rallies up 3 or 4 times, can't make it, and then rolls over again. So it's sort of like when we buy a stock in a bull market, you want to see a prior uptrend and then a base. You don't normally want to buy in a prior downtrend and a base. A lot of people look at a stock and they see it up high in price and high in PE, and that just is not a sound way. That's a personal opinion. You're arguing with the market. Now, the other thing is if you're long stocks, and you sell something that's run up quite rapidly, that doesn't necessarily mean that you can turn right around and short the stock. Don't do that. The shorting should come with a certain type of pattern that we'll show you in a little bit, and it doesn't necessarily coincide with when you should be selling a stock, taking a profit when it's moving up. Now, again, you want to avoid thin stocks. By thin, we mean ones that have a small capitalization, not trading that much volume, because you short a thin stock, they can turn and run it on you real fast because it's too thin. Now, if there's a rumor or some kind of theory or some kind of news, I think that's kind of questionable too. Go back to the chart, and you do the chart work, not the analysis, not the opinion. And we'll show you the patterns in just a minute that tend to work out best. There are 2 or 3 situations. Now, when you start shorting, that may occur at the time you still own some stocks and haven't sold all of them. So you don't have to wait until after you've sold every last thing and then you would conclude you want to be shorting. But you want to make sure that you're in a declining market and it's very clear, and you're picking on leaders that have had a huge, huge run, and they have clearly topped, okay? You don't want to go and short big dividend stocks, because you will have to pay the dividend when it's declared to the person that bought the stock that you sold short. And on top of that, you've got to also have your broker find out if you can borrow the stock. And I found out and I don't like shorting too much really, but I found out that when you're really right, they'll say, oh, well, we can't borrow the stock. I asked them that about Sears a while back, and no, they couldn't. They have to go out and get somebody that will loan you the stock in order for you to sell it short. Yes?
Specifically, why don't you like shorting?
Because I think it's trickier and more difficult, and also it is labeled. When you put in a short sale, it is marked short. And some people know that somebody's shorting a stock. And when they know that they can run them in. And you're going to hear that phrase a few times, running in, because it can happen to you quite frequently. If you don't short exactly right, you're going to probably get run in. Like you're playing poker and everybody knows what your hand is. Okay? Now, you short before it gets obvious to everyone by breaking out below a structure and making a new low. We'll show you on the chart about that. There is a time to short when a stock breaks down, it rallies up 3 times, and one of the rallies gets above the 10-week moving average line, and then when it comes back down through that with the volume picking up, that's the time to short, not when it breaks what we call the neckline, a low, and makes a new low. When it breaks the neckline and it's making a new low, it's obvious and everybody sees it, and that's where they go in and short, and then they run that back up for several days, run them in, and then it rolls over and comes back down. So you don't short at the obvious areas, and we'll go through that in the chart. Now, knowing the stock well before you short it helps. In other words, if you were in this stock on the way up, and you're very familiar with it and how it's acted and behaved, and it, say, maybe has a climax top or something or whatever, I think it helps you a little bit to know and understand the stock that you're shorting. We talked about being able to borrow the stock. Incidentally, I've had that happen to me 2 or 3 times in the last 5 or 10 years. The one that I was really right on, they just can't borrow the stock. Okay, short selling strategies. The best shorting candidates are big leaders of the past bull market when they form late-stage faulty bases. In other words, a 3rd or 4th stage base. It breaks out, runs up a little bit, and then collapses, and the volume picks up, and you can short it there before it breaks down below its whole price structure of that base. Once it does that, it's too late, and we're going to show you how that usually gets run in again. And the best time to short, when we said this in some kind of a, I don't know what it was, whether it was an article or maybe it was one of the books, but the best time to short is usually 5 to 7 months after the former leader has topped. And somebody wrote in a letter to us and said, whoever was a bloody idiot that felt that you had to wait 7 months after something topped, you guys should fire that guy. Because on the surface it doesn't sound right, you know. But we'll show you why that makes some sense. You want 3, 4, 5, 6, 7 months of activity so you know for sure that this stock has got a problem. And there's a pattern there. Now, what are the patterns? We've got a head and shoulders pattern. Incidentally, just because you have a head and shoulders top, and that works in short selling, that does not mean a head and shoulders bottom works in buying, okay? So some people think that's a pattern, and it really isn't because it has a prior downtrend to it on the buy side. I just wanted to throw that in. I think that is the classic pattern. The other thing is, if we talked about it just a few minutes ago, the base breaks out, and it's an advanced base, level 3 or 4, and then fails. Then after you enter that, if this stock breaks down substantially, you need to take your gain while it's still dropping, because sooner or later they will run it in very rapidly. So my suggestion is, if you've got a 20-25% profit, take it. At some point on the way down, it will rebound up over the 10-week moving average line, and when it comes back down through it, maybe you can re-enter, probably at a lower level, but it's a better time when it comes back up through the 10-week and then comes back down. Now, you need to have a set of rules and a strategy when you're doing this. You just don't decide, okay, the market's bad and I'm out of the market, and so I want to sell short, and I think this is a good short over here. That's not a very good strategy. Key thing, you got to cut losses when you're wrong. just like anything else, you shorted the stock at 50 and it goes up to 54, 55, you got to get out of there. And if you freeze up on that one, the sky's the limit and go at whatever price you want to think about. And I think in one of my books years ago, I talked about when Xerox was a big leader and it had this horrendous break, and some guy comes in the office and wants to short 2,000 shares of it. It's around $88. And he said this stock the PE is too high and it has no business selling where it is. And I think when the stock turned around right after that, it ultimately went to 200 and something because they had a great product, and that's why the PE was there. And you were in a really sharp correction in '62, and when it turned, it ran up like mad. So you've got to cut the losses exactly the way you have to in anything else, and you don't want to freeze up on anything. I do know some people that have sold short certain stocks and they froze up, or they felt so strong that the stock was going to be bad and they got seriously hurt. So you can't get away from that fact that you're going to make mistakes. Now, you can see that this one is the head and shoulders top. The concept is that you've had a leader, comes out of a base, runs up, and it has this huge move, and this part is the head, that part is the left shoulder, and this part is the right shoulder. Now, it's critical that when this break occurs, it has to be a very abnormal break with a lot of volume, and it must close below that low. If it corrects here and stops there and does this, that is not a head and shoulders. You must understand the difference, because it has to clearly show that it's in trouble and it's broken seriously. And what happens, ironically, is the amateur that sees this stock and has always thought it was too high and it comes down here, that's when they start shorting it. And it'll go down a day or two and turn and start running up. Now, we talked to you about 3 waves because that's psychology. Let's look at the psychology. You short it here, then it turns and runs up. But you think you're right, and it pulls back here, and you didn't cover there. Then it turns and it goes up again. And if you still were arguing with it, it'll come down and go up again. 3 chances to run you in. And that process takes over a period of a number of weeks. It's not just 1 week up and 1 week down. So a few weeks up, and a week or 2 down, and a few weeks up, and a week or 2 down. And so that's, see, all this time is what builds that 3, 4, 5 months I'm talking about. But you're in process of building the perfect time to short. When you're sure that it's collapsed and had trouble and it's way up there, and then it starts running in the premature short sellers once, twice, 3 times. And one of these 3 times will break out above a prior one. Either the second one will break out above the first, or the third one will. Because what does that do? Somebody think, oh, wow, the stock's breaking out, and it's all the psychology. So once it gets over there and it comes back down, as soon as it comes back down through that moving average line and the volume picks up, you short right there. Now, this is critical that you understand that's the point you short. You don't short down here once it breaks to new lows, just like you don't do that. You get run in there. So you have 3 up here and you break below that. What really happens is if you're shorting in here, they run it back here for a week or 2 to run everybody in, and then it rolls over and it totally collapses. So if you get it there, that is the perfect place. And anywhere along in here, as long as you're not too close to that, but if you're real close to that, you're taking a real chance. Now, one of the charts we'll show you in a little bit, when it rallies up here, at some point it'll come down like that, and it'll start looking really bad, but it's only rallied once or twice. So let's say it's rallied twice, and it comes down here, and so somebody shorts it there because it's breaking so bad, and then it runs like that. And then it rolls over. So you see, the market always moves to disappoint the majority, and it moves to run in the person that thinks they know what they're doing, but they really don't understand what's going on. So this is a little bit complicated, right? And that's part of the reason I don't like short selling too much, because Just think about it for a second. You got all of this time in here, weeks and weeks and weeks and weeks, and there's only 1 week that's really right to short there. And this point is wrong, that's wrong. If you're over here, that's wrong. Of course, if you're shorting on the way up because you think it's too high, that doesn't work either. So there's only one time out of many, many weeks that's correct. And there's no way you're going to get that unless you know how to read charts. And you've got to be looking for that kind of pattern. This other one shows the late stage base up here breaks out. Because it's a third or fourth stage base, it promptly starts to fail. And you want to get that shorting once the first sign of real volume comes in with it breaking down, and you know it's a third or fourth stage base. The general market maybe isn't acting right, but you get it before it gets below here, because below there is too late. In other words, the line doesn't really go straight down like that. It goes down here, and the short selling comes in, it rallies up a while, and then eventually comes back down. So let's go to the first chart, Levitz. Levitz was a big leader in 1972 bull market. It was the leader. This is a classic head and shoulders top. Just look how that stock has moved up. Now, way back in those days, we owned a little bit of this, but we didn't really capitalize on it well because it just kept going up and up and up and up and up, and it never really built very many bases. But at that time, which was way back in the 70s, we didn't quite understand about the 10-week moving average line. This stock bounced off the line here, there, here, there, here, there, all the way until it went in a topping process where this was a late stage base. So you're getting a leader that's had an enormous run, and it finally gets up there, and that's the late stage base. It breaks out here, and look what happens. This is what I mean by you've got to have enough volume and bad breaks where you're sure that this stock now is getting into trouble. And can you imagine if you don't understand second, third, and fourth stage bases, and you're buying up in here, and you get up to where you think you're all happy because you're at $60, and all of a sudden it opens at 49 and then goes right straight to 34. That's a pretty big break from 60 down to here. So this starts forming the right shoulder, and you undercut this over here, but this is breaking very rapidly, and if you're selling short in here because you see it's breaking that support, it'll go down for maybe another hour or two and then turn and run on you, and this is what happens. So from 34 to 50, 51, you're going to get run in. Unless you've got nerves of steel and you're not too smart and you're just going to... what kind of percent is that, you know? So, again, I told you you've got to cut losses at 7 or 8%. You think shorting is a way to make a lot of money? If you don't do it right, you're going to have a loss a lot bigger than any 7 or 8%. So now count. Here's the first run-in. 1, 2, 3, 4 weeks. They run that son of a gun up until finally somebody says, I can't stand it any longer, and they finally cover. Then you come off, but you take a second run up. Now here's that situation where I said, now it really starts to break again. 1, 2, and the third week it breaks down rapidly, but it hasn't come down to here yet. So maybe the person that shorted there and covered up in here somewhere finally shorts it again here. And as soon as you do, there you go, 1, 2, 3, 4 weeks again, and it gets back above the line. Now you've had 3 run-ins psychologically. The first time, the second time, the third time. And if for anybody that stayed in there, they eventually, anybody that's going to cover, let's see how many weeks that is. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 weeks. If somebody's short, you're under pressure all the time. It rallies up and it comes back, and it rallies up and it comes back, and it rallies up over 15 weeks. And you're sitting there sweating all the time. So see the psychology of why it tends to rally 3 times? In other words, you won't see a head and shoulders top where it breaks once, it rallies once, and then goes down. It will run in the short sellers first, and once it's run in, almost everybody can have that happen to them, then it will finally break. And boy, is this ever the time. So that's false, that's false. And as soon as this stock comes down through that 10-week line, right there is where you short it, not down here. Because if it breaks below that and you say, wow, it's breaking below that, now this one didn't rally up very much, but it did rally up some the next day if you're down in here. Normally, at that point, it'll go a little bit and come up like that and then come over. But here you go. There's the perfect time, and you've got to get within just a few points of that area as soon as it's down below the line and the volume's picked up. And that's what you do. Then at some point, you rally back up over the 10-week, and this fools everybody. It just touches above that over here, then it breaks again. This is kind of abnormal, the way this is acting. It comes down again and rallies up. But you see where the stock ultimately goes. I would still say you take the profits while you've got it. And if you're re-shorted at some point, I'd take the profits while you've got it. This is a little bit of an exaggerated example because you retrace the entire advance and you did it very rapidly. But even with that, you would be fooled if you didn't know exactly where it was safe to short. Now let's look at the certainty. Again, a stock that back in the 60-61 period has this huge move. It's never done much in its life, and yet there was a stock that was in, I don't remember the name of it now, automated house building. And this stock, Certainty, decided they were going to go in that business because the prior company had a big move the year or two before. So it runs up. Here's a high tight flag. Takes off and goes. And now it's going at a little slower rate. So this is the head. This area in here becomes the left shoulder. And these shoulders are usually fairly thick. There's a lot of time in there. And this stock breaks rapidly and it undercuts this area. So you can see again, there's a point where somebody starts thinking, boy, it's breaking a little support area there. And you short and you rally up once, come down, rally up twice, and you go above this. And then you come down. Now here's the example I'm talking about. Here's the first rally up, second one. You come down and you undercut right there. So you're breaking out of a base, theoretically, is what a normal investor is going to think. And you short right there, and what happens next week? You short at 41, and it goes to 47. So they're always going to go more than the 7 or 8%. Now, if you get run in there, then the real correction starts. After 3 chances to run you in and create the psychological thing where anybody that's going to be faked out is already acted, and now it breaks for real. So the first time you try doesn't work. The second time maybe doesn't work. But the third time after that, they give up and you just start having the real correction in the stock. So there's where you would short when it goes above that line and it comes down here and the volume starts to pick up. You can check it and see your volumes. So that was Certainty. Now you're going to see this pattern, the psychological pattern, repeated over and over and over again. Because in the stock market, the obvious does not work. If it's obvious to everybody that something is weak and bad, it isn't going to work. Or if something is obvious that this stock is so good and so great, it isn't going to necessarily work. All right, here's Lowe's. This was the old Lowe's theaters, and when you got jets coming in back in the 60s, there was a shortage of hotel space, and so they sold a lot of their theaters in downtown big city, and they started building hotels in the city. So there's your move, a big cup, goes up and up. Here's 3 weeks tight. There's a flat base. Just bases and bases and bases. This one comes down and corrects a lot. You see up here, you're very, very late stage base. Now this becomes the left shoulder. You run up, and you have to break seriously again. You've got to undercut this. Bang, bang, all the way down. And then you start, first move up, and pull back. Second move up, then you go past that. And that moves from, say, 37 to 49, 12 points, so whatever that is a percent. Then you pull back a couple of weeks, and you try one more time. Then you start down, and over here is where you're breaking below after the 3 moves up. You're breaking below right there. That's the time you short, and it goes over here, and I would say you cover when it's done 20, 25%. We're showing you some outstanding stocks that were huge leaders and had huge breaks, but you aren't always going to be shorting that outstanding one that comes off a great deal. Maybe you're shorting one that'll break 15, 20, 25% and turns and starts a rallying business. So it's better to take it while you've got it, because when you don't, they can run it in very rapidly. So now, volume is important, and you recognize when the stock, after a large run, finally gets hit hard with the largest volume it's probably had since the beginning of the whole move. And it'll show up in there somewhere. So you're more certain that this stock has gotten into serious trouble. And that's part of why you have to wait until after some time has occurred before you short it. If you short it too soon, the first 2 or 3 times they're going to run it back in. And let's look at control data. The big computer stock years ago, interesting to note, there was a bear phase, and over here was a follow-through. Market runs up a little bit and pulls back in here. This breaks out. In my book, I think we talk about you're buying when something breaks out, and up to 13 weeks, I think, you'll have some stocks breaking out. Well, this one probably broke out. It was on the bottom at that point. This was supposedly a laggard stock. It didn't have real earnings in this period, but there's your cup, there's your handle. So after the follow-through, 1, 2, 3, 4, 5, 6, 7, 8, probably the 8th or 9th week, you're breaking out on that, and it becomes a big leader. And there's the first pullback to the 10-week, the second one. Now you get up here, and you get quite a different kind of pattern. And this fails up there because it was so big and loose and much, much different than everything else that had been prior to here. But this stock goes back and forth all over the place, and you still wait until it shows clearly that it's in deep trouble, and it breaks bad right there with a huge volume, 1.4 million. The daily break was larger volume than on any time period throughout the whole history of the stock. It goes sideways for 10 or 12, 13 weeks, and as it goes sideways, the 10-week line finally catches up with it, and you go above it, and when you come below it right here with the volume, again, it picks up, and you're shorting on this volume goes from 180,000 to 400,000, so the volume doubles in that week. The day that it's breaking through there, you'll see the volume picking up, and you try to get it just as it's coming through there, and that comes apart. But again, it was a huge leader in one cycle. Now we'll go to the next one, Hilton. Here you had the beginning of its move. There's the left shoulder, there's the head, and here's our bad break that we're watching. Remember, it must get below there. You do not want the break to stop, say, about that point or in there. It's got to break this whole structure, which it did, and it will do it on volume. The person that shorts the stock in here because it's broken that support and it looks terrible, there you go again. This one comes from, it looks like about 84 to 104. What's that, 25%? So that's what you're dealing with if you short when it's obvious, all right? Now, again, we're under the psychological thing. And now this is in 1989. We were talking about 1960 before. So remember something. There are two things that do not change in the market. One is the law of supply and demand. In other words, you have a lot of demand going up here, and all of a sudden here you're getting supply overcoming demand. And human nature doesn't change. So this same thing goes on cycle after cycle after cycle because human beings do not change their psychology. I suspect if we went back 200 years, you would find they were doing the same sort of things. There were people that were probably gambling on something else, and they had certain theories and all. So here's number one. Here's number two. And see how it has to surpass that point? Because if they didn't run you in there, they can scare you by breaking out a little bit. And then you come back, and then there's a last third gasp attempt to get everybody out of there that they can, and now it starts breaking. And here, if you short back in there, it tries to rally up a little bit, and then it continues down. So history repeats itself. Human psychology never changes. Everybody's going to make a lot of money in the market, and yet everybody's not willing to do a lot of work. You know, there are some people that are a little bit lazy, right? So the market works against them. If you don't do your homework, you pay for it. International Game Technology, IGT. Now, isn't it interesting? Here we're talking about short selling, but look at all these patterns. And if you were back in 1990 and you had a chart book and you understood what we're talking to you about, you'd see that pattern. You'd say, wow, look at that. There's a cup and there's a handle and it's drifted down and wow. And look, and the earnings would be turning up, and you get into that stock, it has this big move up here, and there's a base on base, and it continues up, and finally corrects a lot and comes out again and still keeps going. Now, these are split adjusted things. See, that's split 2 for 1 here, 2 for 1, and 2 for 1. So none of these stocks are selling at $2. You know, they're 25 or something else. But just look at that move. If this is $2 and you're going up to 40, what kind of percent's that? So those are the kinds of things that show up. Just look, here's the S&P. Over here, it's turning up, and here's a little pullback in it right there. See, some of the stocks are right at the bottom at that point, and they have to build the left-hand thing and then do that, and they break out there. But you have this correction, and there's probably another fall-through right there, and that's when it's coming out. So let's look. This has to come down below that, 32. So let's say it's breaking down there, and somebody short at 30, 31, and it rallies up once, comes down almost to that low, not quite, so somebody else might short there, and it comes up and just breaks above that. I wonder why that peculiar little thing happens just that way all the time. Now, here it really breaks, and you undercut the base, and you're shorting there, and that was 1 time, 2 times, it hadn't had its 3rd time. So they sucker you in by breaking to new lows, and then they get the 3rd move right up there. You have to have the 3 waves. Now, occasionally you'll see 2 waves, but almost always you'll have 3, because if they don't get you the 1st time or 2nd time, they get you the 3rd time. And human nature doesn't change, so we're talking about psychology. Now you come down, and you cover it somewhere in here, and you run up rapidly, and maybe you can short in there, but if you're not careful, you come down here and they run you in there. So it's not easy, it's tricky, and there's 1 time that's right, but I think you're going to understand what that 1 time is and the kind of risks you're taking and what you've got to avoid. Sometimes when you're learning about the market, the first thing you have to do is unlearn all the things you thought you really knew. And that's kind of tough, particularly if you're successful in your own business, you're an attorney or a doctor, or you own a business, and you're real successful and you're a pretty sharp person. You just assume that you're going to be sharp in this, and that's just not true. So you'll have certain theories and certain beliefs, and, well, I want to buy stocks that are reasonably priced with PEs, or I want to buy something as it comes down because I feel it's a better bargain now, or it's safer. You got all these ideas, or I subscribe to Value Line, or I subscribe to this or that. You've got to start by throwing out all the stuff that you have used in the past that really didn't work too well, okay? And so you start all over again and find out, how does the market really function and work? and then you get on the right path. But if you still carry along some of those old beliefs, you'll keep making some of the mistakes. All right, let's go to the next one. What's the next one? Amazon. It's kind of breathtaking what some of these stocks can advance too, right? You only need to get one of them in the future. But in order to get one, you got to know exactly what you're doing, okay? You can't just guess at it, or can't take some tip or rumor. So you see these bases going up. And there's a huge wide loose base. As the market turns, it's coming out of that right there. So this is all over the place, very loose, because you're in the wild period of '99 when everything was going crazy. We try to break out there. Now, no one would buy this knowing this is a big, wide, loose cup with a handle. And there are several ways to see if something's wide and loose. It's the percent from the top to the bottom, more than 50%. In other words, when you come back up to a breakout point, you're going from 40 to over 80. You've had to double before you even got to the breakout point. So that's one way you see it wide and loose. The other thing is if the vast majority of the weeks are wide spreads. Look at the spread from the top 110 to whatever that is, 80 something, and the wide spreads are all the time. So that's constantly in the view of the public. All this wide stuff, you can never buy something like that. That's a faulty base. So this becomes a left shoulder right there, and you break, and you get down here to undercut there, and somebody shorted there, and it turns on them, and immediately goes from 58 or 9 to 77. You can figure that percentage, and notice how fast it goes too. So if you're wrong, sometimes it goes back just like that. And if you sit and want to think about it, already you're down 15%. So there's the first run up, and it comes all the way back down here, almost getting ready to break out again. And I guess you had a rally up here. You could say there's a second one in there. And if somebody shorts there, because maybe you touched below, no, you didn't touch below that, but you got almost down there. And there's your third run up. And now you break here, and if somebody is adamant that they just want to get this stock short, when it breaks there below that low, what happens? Now, I'm not sure how this evolved, but it looks like the stock turned and ran up to this point to get them out, and then rolled over and broke. So even if you were stubborn and you kept at it, which you will not do, because once you get burned twice, you stop usually. You say, this is the last time I'm going to mess with this stock. So it rallies up there again, breaks to here, and rallies up there again. I mean, this stock drives you nuts. So you cannot be shorting at these points when it's obvious. The only way you got a chance is if you short the first time you come back through that line after you've had 3 rally ups. You could be shorting there, and maybe it didn't run up too much, and you got away with it, and you made your 20%. And if you didn't make your 20%, then they took it away from you, and you wound up losing money when this thing turned and ran back up. So it's very, very tricky. And remember something. When you put the order in, it is labeled a short sale. So somebody is out there knowing that there's some shorts in the market, and let's run them in. Price line. Now we're back to 08. And since we're talking a lot about historical precedent and what we learn from studying history, there's where you pick up the perfect cup with a handle. It gets a little bit of new high ground and has to come back sharp, but it does what it should. And there's your buy point. And this here was probably your follow-through day over there. And you got 13 weeks. Maybe this came 4 or 5 weeks after the follow-through day, but from 32 to 140, and having that long, long run. Then we get up into the late stage base again, and this breaks out there, and starts to fail. And when you start picking up on volume here and you're coming below the line, there's where you start shorting. This is a little different than the head and shoulders top. This is where you have a base and it breaks out and then it fails, but it fails with the volume picking up as it's failing. And when the volume picks up and it gets below that line is where you'll be shorting. You do not wait until it gets underneath the base that failed. In other words, in order to see that a base has failed, you don't have to see it go out on the top side and then come down and undercut the bottom side. You got that? Some people think that's when you know it's failed. Well, by that time it's obvious to everybody it's failed, and you're shorting and you get into all that whipsaw stuff. So underneath here, if you short there, it rallies up, drops here, and if you short there, it rallies up again. And you keep that sort of thing going on, so even though it isn't a head and shoulders top, you kind of rally up once, you rally up twice, and here you rally up 3 times, and you're all over the place. So you've got to do this right, and there are 2 different basic patterns. One is a cup with a handle that'll break out a little bit and then fails. As soon as it drops enough that the volume starts to pick up and it goes below that line, that's way before it gets below here. Below here it's obvious. There it's not so obvious. Okay? So that was price line. Let's look at Chico's. The thing that's interesting about the stock market is there are all these big leaders that have phenomenal moves, and most people don't ever buy them because they don't use charts, or they don't understand that you've got to buy something that maybe looks like it's high, or maybe you don't know the company, you don't know this stock, and you don't realize that this is a base pattern and that's a base pattern and all that. The thing that's fascinating is the kind of profits that can be made, and then when you're finally wrong in something, how much it can come off. Look at that high. What is that? 49? So let's say it was around 50, and it goes to 1. Now, what kind of percent is that? So another rule that you never, ever, ever violate is you cannot freeze up, ever, period. You say, yeah, but I know that this is a great company. I used to work for it, or whatever. You don't know where it's going. Nobody knows over here that it's going to there. But what you know, if you know what you're doing, is get me out of there. Okay? I don't want to stay around until I find out what can really happen. Now, we did a study on these models, and we found that when the average leader tops, it was I think it was around 72%. Well, how can you withstand a 72% correction? Let's say you had an index of 100 and you lost 72. Now, I got to see if I get my math right here. What does that leave me with? 28. Now, what has the 28 got to go to get you back to breaking even? 330%. How many stocks do you buy that make 330%? So, see, I'm showing you all these deadly things that you've got to understand so you never, ever freeze up. And you can't say, well, Apple's so good, I know it's okay, and it'll come back, and it'll come back, and it'll come back, because I love Apple. And I know a lot of people own Apple because it's so good. But at some point, it won't be good anymore. And the chart will eventually tell you when that is happening. And you don't freeze up, you don't argue. See, all these things are opposed to human nature again. The psychology. Once it is so great that it's going to go on forever, it probably is all through, because everybody that can buy has already bought it. And if a stock doubles and triples and quadruples and keeps going up, it gets bigger and bigger and bigger, and they can't sustain that same rate of growth as they get bigger and bigger. And as they get bigger and bigger, a bunch of other people come in and start copying, and all that sort of stuff happens. So it's good while it's good, and the average duration of a big leader is 1.5 years in the period where it's really performing in outstanding fashion. There are some exceptions. Google was an exception, and Apple was an exception, and Microsoft was an exception, and so maybe they last 5 years or 10 years or maybe 12 years, but sooner or later, They all have saturated their market, and somebody comes along with something better, faster, cheaper, and they're through. And you never know how low they're going. So that destroys the long-term investment concept. Where the fallacy is there is, yes, there are some people that made a lot of money by just buying something and sitting on it. And they were lucky because they happened to buy the right thing. But now for every person that did that, there's somebody else that bought General Motors because it's General Motors. And there was a time when AT&T was followed that every widow should have AT&T, and it promptly goes down 70% and things like that. So anything can happen to anything. And the few people that maybe made a lot, I remember when I was very early on in the business, there was somebody that owned Avon products and made a lot of money in it. And I tried to get them to sell it, and they wouldn't sell it because it was Avon products. And for 5 or 10 years, it was a pretty pathetic performer. Now, I don't know, maybe eventually it came out and went back up some. But usually when a leader tops, it does not come back in the next cycle or several other cycles. When RCA topped, because the radio was invented in the 20s, it didn't come back until they had color TV, and I don't know, that was the 70s or whatever. So from 1929 to 1970, let's see, you got a long gray beard waiting for it to come back. You got to understand how the American economy works. It's so fascinating because there's innovators all the time coming up with something new, something better, something faster, something cheaper, and they outmode the others. The others get bigger and they get carried away with themselves. We owned AOL and we sold it luckily up around the top. Not luckily because it had a climax run, but I remember when they had Time magazine, the CEO had his picture on Time magazine talking about how great and wonderful it was when they were having this merger. And he had this silly little grin on his face. And I've always seen that as soon as that happens, forget it. Once they finally get their picture on Fortune or Time or something like that, it's all over with. So nothing lasts forever. And this is a good example of it. A good retailer with some pretty good products goes all the way to $1. And people carry these things down because when it gets down over here, you're saying, well, it just can't go any lower, or it'll come back, or I know the head of the company, or whatever. There's always some excuse, some alibi, and there are always opinions and feelings. You don't ever freeze up unless you are willing to go bankrupt. Yeah. Deep in the money puts as opposed to going short. Well, I don't really recommend going short unless you're really working at it and you're really, if you've been able to average 25-30% a year and you've got it all figured out, well, fine, then go in. But now you know, I think you know how tricky it is. So if you're willing to be disciplined and all, maybe you can do pretty well if you get in a bad market. But I'm just trying to show you it is not easy. And talking about puts and all that, I try to keep things as simple as possible. Either I want to be in or I want to be out. And I don't want to be long and short at the same time and hedging. And you have these things where you can buy covered or you can sell covered options and all sorts of things that are out there in the market. And they're too complicated. And there's usually a fallacy in the concept. Let's say you have a good growth stock and you sell to somebody else an option, the right for them to call the stock away from you, and you're going to get a little premium for it. And you do that a lot because, well, you pick up some extra money, you know. Well, if that stock really has a big move, you lost the big move for that little small thing. So I don't see that the odds are all that good with it. And sooner or later, there comes a problem with all these various ways that people think you can make a lot of extra money. What's the next one here? Crocs. Well, there's a good example. You know, those shoes are pretty neat. The material was good, and you feel good in them. And here it comes out. There's a follow-through day in the market. There's the stock breaking out of a base right here. Runs up, has several stages. Here's our left shoulder. So that is breaking out at, say, $15 over here. So 15 to 75. And that's not too much time, about a year or a year and a quarter or something. So 15 to 75. And here's first stage. This would be a second stage, because this may not be quite 20%. This would be a second stage. Here's your third stage base again. Third stage base is going to fail 70-80% of the time. Goes up here, and everybody's excited because they're making so much money so fast, and then there you go. And it has to break below that low of that base. So there's no question that it got hit, and it got hit very hard. And this kind of shows you another thing, that you got to be able to make decisions in the market, okay? You got to be a decision maker. Maybe you're intelligent and you figured everything out, but if you vacillate and you can't make up your mind, and I'm not saying you want to be impetuous and you rush in and rush out and all that sort of thing. If you have rules that tell you when something like that's happening, if you didn't sell into the third stage base, or you hesitate a little bit, still you know that once that volume comes in and it gets below there, you got to get out of there. So you got to make decisions, is what I'm saying. And you're going to be right sometime, you're going to be wrong sometime. And you're right sometime, you're wrong. But you can't freeze up, is the message here. And you could be right in almost everything you're doing for months and months, and for maybe a few years, and just once you freeze up, you could get hurt, okay? I used to tell this story. There was a fellow, I won't mention his last name, he's not here now, but his first name was Don, and he was very good at charts. He made a lot of money. He could buy bases. He bought some stock, I don't even remember the name, and he kind of froze up because he really liked the stock. He had studied it. It had gone down a fair bit, and he didn't cut his loss for the first time. And he comes into me, and he shows me he's written a 15-page report about how good the company is. And this guy never wrote a report in his life. And I looked at him, I said, what in the world are you doing? You're showing me this report? He'd been doing so well for so long, and here he was freezing up, and he just believed this thing was good. And he was writing all this thing to try to justify it. So you might have loved this stock, but at that point you don't love it anymore. There are no good stocks unless they go up, right? And if they go down, they're bad stocks, okay? They're all bad. Remember that. So there's what can happen to you if you hesitate and you want to wait, well, it'll come back or something, you know. And every once in a while, that's a psychological trap too, because it breaks down and it does come back, and now you say, well, now it's okay. Or maybe you're silly enough that you go actually buy some more because you think you really like the stock. So it rallies, but if I were at $70 and I'm waiting for it to rally, and it rallies a few weeks here, I want out up there. I don't want out down here. It comes over the line, and it can maybe be shorted there. Comes over the line here, may be shorted. But what was that percent drop? 75 to really, in effect, almost 75 cents. So what is that kind of a percent? Who's the mathematician? 99%. Sounds like the 99-cent stores, right? Oh, you could only lose 99%. How much percent-wise do you have to make to get that back? You're probably already broke and have gone bankrupt on that. You never go bankrupt. Never. If you follow the rules, okay? TESOR. TSO. This is an oil company. Long move. Now, here was a base failure. One of the reasons this base failed, see, it wasn't really a third stage base, but this base was a faulty base. It was wide and loose, much wider than some of these. But there's too much work done here in the lower part of the whole structure. 64 to 42. This is doing work 46 to 52. That's a weak situation, and it finally breaks out there and it fails. So the failure, we don't short it there, but once it breaks this moving average line and the volume picks up, we short it right there. And we do not wait until it breaks here to say now the base has failed, because you short it in there and you get this run in. another one, and another one. So if you shorted there, the odds are you lost money. If you did short here, and you're taking it at 20%, right in there, after it comes back through this and comes down, you could reshort it there, and you take your 20%. And didn't short it here because it didn't quite get above that line, but this time it does, and it could maybe be sold short there and at 20% there. Sometimes this works. So we really talked about 3 different ways you can sell short. A base that's a late stage base that fails as it starts to come down with volume picking up and finally it goes below the line. The head and shoulders top, or this situation where it clearly is in a downtrend and it comes back up here. And some of these can be tricky. Sometimes it'll go back and forth a few weeks and maybe you get run in. But those are the only 3 places that make any sense in selling short.
Repetition is the key to learning, so we recommend that you review the 11 examples just covered by Bill, plus go through all the examples in the chart book. This will prove very valuable when you yourself attempt to short, since you'll know the characteristics of a good short candidate. We hope you've enjoyed the short selling home study and wish you much success in your future shorting endeavors.